Hello, traders. So, as you know, I like to replay some of the trades that we can learn things from. Some of these have been bad trades. This one actually turned out fairly well at just under a 10% profit, or $1,100 in this case. But it's also good to replay trades that went well. So, this is a RUT Flat Fly with a long call. You'll see what it's made up of here in just a minute. I made a note in the journal here at the time that this trade was opened, which was back on January 22nd, that the concept here is to capture a wide of a tent as possible, and then also purchase a long call so that if our market continues to rip up, that long call would help us out a little bit, essentially mitigating some of the risk to the upside in this trade. Now, it only mitigates that upside risk early in the trade because as that long call continues to decay, things get a little uglier, if you will, on that long call. So I'm going to go ahead, take a look at this trade. We're going to walk through the various adjustments. This trade did have a fair amount of adjustments to it, and that often will hinder the profitability of the trade. And in this case, I do believe it hindered the trade, but it was still managed well and worked out well. So the concept here is initially we were putting on a flat fly. And I said going into this is one of the very few trades, in fact, possibly the only trade that I do that needs to be done in a specific ratio. And what I mean by that is you have to have a certain number of butterflies to offset a long call, which you'll see here in a second. So this is the actual fill. The solid line shows that my butterfly here was filled. And then I wanted to add a long call. So this was the proposed long call, buying a 2140 long call when we were only trading at 1973 at the time. And then I got filled on that long call. And this ended up being the position on the 22nd after everything was filled. You'll notice that this long call all the way out here at the 2140, it is a ways away, and that does create a valley of death here that will continue to decay. That long call will continue to decay out from under us. The goal here in putting these on is ideally to get this long call as close to the long puts here as we can, because the closer that is, the less this valley of death will be a factor. So in the ideal world, I might have even put this on in a little bit larger size yet, maybe 15 lot. And then if I put on a 15 lot, I might have been able to have my long call down here. But this was acceptable. So this is what I went ahead and went with to kind of keep the overall risk of this trade as low as possible, but it's still way larger than most trades I do. And again, this is not a trade, that can be done outside of this ratio, because if you only did, let's say, 2 butterflies and only spent whatever, $2,000 for those 2 butterflies, your long call would have to be so far out in the distance here that it would not make sense. It would not help or support this trade if the market did in fact rally up into this area. So that's why it's so important that this has to be in a ratio. So let's look at our market on January 22nd and see what prompted me to open this. So this is the RUT. This is January 22nd here. So the volatility was still up a little bit, which means we can get into our butterfly for less overall money. A higher volatility means we pay less for that fly. So we still had a decent volatility. We were looking at a possible resistance area, which means the market might pull back a little bit. And the market pulling back actually favors this butterfly slightly. So those were a couple of the factors that went into doing that at that time. Then we can just kind of, march forward here. I'm not going to go day by day, but we can see end of day here. We can see on January 31st. So on January 31st, this thing started showing some decent profit. So what I did at that time is I said, you know what? I'm up nicely in this trade. I was up about 5%, as we can see over here. And that was in a matter of a few days. So I thought, you know what? I'm going to go ahead and thin this out. So I placed an order to thin out a couple of butterflies. That did two things for me. Not only did it thin out and lock in some of these profits, but we can see this purple dashed line. Our valley of death to the upside was starting to get a little bit deeper. Taking out some butterflies means that I now have less butterflies that need to be supported by this long call. So if the market were to rip up, I'd be a little more stable in this valley of death. So that was kind of the main decision factor for making that adjustment. And here is the trade after that adjustment. So I've reduced my overall risk in the trade. It was up just shy of 15,000. Now we're down to 11,000. We're up $560. My T0 line is flat to the upside. All good things. So let's take a look at our next adjustment. So then nothing happened all the way until February 21st. So almost 3 weeks later. At that point, our market had moved up a little bit, not a lot. But again, the big factor here is see how my valley of death is dipping a little bit deeper here. Meaning if we did rally up considerably, this is going to be problematic. We can see that also in our deltas here. We're at -6 delta. So I wanted to flatten those deltas, meaning that if the market ran up further, that I wasn't going to be suffering pain up here. And you can also see profitability is up to 798 at that point. So again, lock in some more profit. So I took off 2 more butterflies, and this was the position after those 2 more butterflies came off. Then we march forward in time to February 27th. So on February 27th, you can see we had moved up considerably at that point. And so basically, and it looks like there's actually maybe a prior, so this was all the roll-up. So to do a complete roll-up, let me come back here just a little bit. So this was the position prior to me doing the roll-up. We are outside the tent. We're back, we're up nicely. A case could have been made to close this entire trade out right here as well. That might have been another good option to consider. But I was no longer able to just thin out butterflies because we had blown outside the upside of this tent. That wasn't going to work quite as well at that point because theta would start to work against us. That long call is going to decay faster than the few butterflies left were going to decay. So that was going to give me negative theta in this trade if I took that approach. So I really had to roll this entire butterfly up to get it back under the tent. So by rolling this entire butterfly up, just taking off this lower run, recentering this one in a way that I didn't have a big valley of death here. I could have some decay happening. I was comfortable with this. So this had to take place in a couple different stages. And I laid both orders out there. I laid my order out there to close this lower one at a price that was okay. And I laid an order out there to open the new one. The new one happened to have gotten filled first. And I ended up in something that looked like this, but of course this had a lot of negative delta. I did not want to maintain this position. So I had to work then at getting the other side of this thing closed as quickly as I could. And I did ultimately, and this was what the new position then looked like. So I'm in a sweet spot here. My theta decay is higher. I'm slightly positive delta. Now, this is on February 27th, so I guess I should take a look at our market here coming out to February 27th. So that's going to be right in here. So, we broke up to new highs. We were looking, not new highs, excuse me, but new highs of the recent. It was a big gap up and running higher. And as we know, in recent times, that often means a breakout, which did end up happening a couple days later. So that's why that move was made. So now we're in a whole new position. But keep in mind, this cost a lot of money to do in commissions, and it also cost quite a bit in slippage. So, these are not things that you want to do lightly or do quickly, a complete tent roll. because they will impact your P&L. And again, I do believe that this would have negatively impacted the P&L on this trade over time. And, you can see actually that did strip out most of the profitability in that trade, making that roll. Again, that's due to slippage and also just the process of commissions in here as well. So now we're almost essentially back to ground zero. So right now we're thinking, oh man, maybe I should have just closed that thing. And again, would have been a perfectly good thing to do. But this is a pretty good structure to be in given our bullish market sentiment at this point. So we roll forward here. The next adjustment was all the way up here in March 11th. So on March 11th, we had profitability coming back into the trade, stripped out a couple more flies here. And again, that helped remove this valley of death. This valley of death is going to get steeper and steeper the closer you get to expiration, because that long call is going to start to gain faster and faster as we go through that process. So this was where we were filled there. And then little later here on the 12th, next day, I stripped out even more, again, making that valley of death not quite so steep, locking in a little more profit. Then March 15th, and again, the closer you get to expiration, the faster your options are decaying. I came in here, again, stripped out a little more, decent profit, and just taking the risk out of the trade, particularly the upside risk. I need to keep this, I need to keep my delta fairly neutral. I want to keep theta as high as I can because that's working in my favor. But I did not want this risk of what this blue line was here, that valley of death. So taking out another butterfly helped with that situation. This was my position after that. And then we get to, March 19th, which is when the trade was closed. So I chose to close the trade on this day because there was a Fed announcement the next day. RUT ripped up, and let's just see. I haven't even looked here to see what. So RUT was up at 2103. So 2103. So this trade would have given back a significant amount of its profit at this point had I not closed this prior to the Fed announcement. So this trade was then closed out on this day at $1,100 and I think it was $76 in profit after all the commissions, after all the slippage, so about 10%. So I would say this is a trade that was managed effectively through the process. There was the one sizable surprise of this upside run here. Not that run. It was, this upside run here was fairly significant, as was this upside run here that we're currently in. But of course, we were largely closed out before this occurred because this was Fed announcement day here. This trade was actually closed out down here on this day. So hopefully you find this run through of a favorable trade to be of value because, of course, we've also run through some ones that we needed to learn some things from. This one, I think the take-home message is that despite some pretty sizable adjustments and a complete roll of the tent, which is not normally something that happens in that trade. We have to be prepared for it, but it's not a normal happening in that trade. I would say it happens about 30% of the time or so. Despite that, despite the slippage, despite the commissions, this was still able to eke out a decent profit. And more important than that, notice that this T0 line never got really out of whack. Almost the entire way through this trade, this was manageable. If there was a big upside rip, it was a little more vulnerable to a downside move. But again, I was okay having my vulnerability there when we're looking at an uptrend like this. I didn't feel like there was as much downside risk actually in the trade based on market conditions. So again, hopefully you guys find that of value, and that's it for now.